What's up guys, Raymond here with episode 13 of our financial statement analysis videos of the German industrial stock list. And today's video, we're going to be analyzing the financial statements of a stock called Hochtief. Please correct me if I'm pronouncing the name wrong. But without further ado, we're going to start off by looking at the key ratios, and then we're going to move on to the three financial statements, starting with the income statement, ending with the cash flow statement. If you're new to my financial statement analysis videos, what we do is we analyze the top three financial statements that are relevant to a company, those being the income statement, the balance sheet, and the cash flow statements. And we look at the key ratios of each, or the key factors of each statement, and we try to come up with an overall idea of how well the company is doing financially from the past performance up to the current date. And we try to come up with an idea of how well the company would do in the future. So without further ado, we're going to start off with the key ratios. But before we get into that, as you can see, I invested £1. I'm not sure exactly when. Let's just say on average about 6 months to a year ago, and I've received a negative return of 20%. So that just shows you how well you would have done if you had invested any money about a year ago. So the key ratio suggests that the company's market cap, which is the overall price of the company, is around 4.05 billion euros, which is really good, strong and large size. The P ratio, which is the overall expensiveness of the company, divided up into how many years on average, if the company's growth rate stayed the same, how long it would take for you to receive a return on investment, or return of investment. So the revenue figure, which is the overall sales figure for the last financial year, was 21.38 billion euros, which is really good. The earnings per share, which is the net income divided by the amount of shares outstanding, or the amount of shares available to the public, for the last financial year was 5.51 euros. Let's just quickly check the stock price just to see on average the percentage return on investment you will receive. So I assume it would be about 10%, simply because the the PE ratio was 9.44, so that's about 10 years. So if you divide that into a percentage, that's about 10%. The dividend yield, which is 3.67%, which is really good, just under 5%, which is what I would classify as a dividend stock. Sorry about the background noise, by the way. I have construction in my neighbor's house. The beta level, which is the overall risk level of the stock, based on the volatility of the stock up to the current date, is 1.38. So it's about 38% above the market average of 1. The revenue figure, which is what's going to be depicted in the income statement, is the light purple figure, and the net income, which is how much the company's made when they factored in expenses, is the dark purple figure. But in the 2020 financial year, you can see it's quite small. So the 2020 financial year, there's a very, very small net income, and in the 2021 financial year, there's an almost unnoticeable net income. So as you can see, this company doesn't make much cash for investors. So I'm assuming that that won't be the main reason why people invest in the company. So as you can see, the revenue figures are very, very high. So I assume that because, considering that the net income figures are so small, because the revenue figures are so high, and even a small net income, although it might not even be up to 2 or 3%, is enough for shareholders, considering the dividend yield of almost 4%, to invest in. So let's get into the balance sheet, which depicts the company's liabilities as a ratio to its assets. So the income statement didn't show anything positive about the company, I'll be honest. And the balance sheet, just looking at it now from the graphs, doesn't show anything positive at all. As we've said in the past few videos, debt to asset ratios are one of the key factors that prospective shareholders look at to be able to determine whether or not a company is a risky investment or not. And as you can see here, the dark purple figure represents the liabilities, what the company has borrowed from outside parties, and the light purple figure represents the assets, what the company actually owns. And as you can see, the two columns are almost identical, which means the company has borrowed almost as much as what it actually controls. So the company is going to be paying a very large amount of interest on the amount that is borrowed. And as you can see, is the amount that is borrowed compared to the amount that it controls is almost consistent over the past 3 financial years, which means it will probably continue that way into the far future. So the company's going to be paying a very large amount of interest. And considering that the profit margins are so very tiny, I assume that almost all of, I believe even more than what the company's made in profit, the company will be paying out in interest. And if it's deferring the interest, that's even worse because it will be accumulated even faster. So the company really needs to figure out a plan of increasing net income by quite a large amount and also managing to reduce debt by quite a significant amount. But I don't see that happening to any significant degree in the near future. It will take at least 10 to 20 years for it to actually do a noticeable to actually reduce the debt to a noticeable amount that it won't affect net income so much. So the cash flow statement, let's just check that. The cash flow statement starts off with the net income for 2021 was 288.92 million euros, which is good, but the company's size is large enough that doesn't make much of a difference. Considering that the dividend yield was 3.29%, I don't know how it paid out such a large amount, considering that the net income wasn't even 3.29%. The cash flow from operating activities was 387 million euros, and from investing activities, the company spent 79 million euros, which is almost nothing compared to its size, on capital expenditures, and 140 million euros on other investor cash flows. So the company is not growing very fast at all from year to year. Let's check the financing activities. Cash flow items, finance and cash flow items. The company has paid out 74 million euros. Let's just check retiring debt. So the company is the company's really trying to reduce its debt. It reduced almost €1 billion worth of debt actually. Yeah, that's actually quite a substantial amount. We're going to check later how it's done in the past. 224 million euros gained in foreign exchange effects. That's a very, very good amount. And the net change in cash was about 682 million euros. So the company lost almost exactly the amount that of cash that it used to pay out to reduce its debt. So it's gone into a deficit of cash to be able to pay off its debt, which is I would say is not the worst idea, because if you're a deficit in cash in your bank account, you're not less, or on your books, as a company, you're not necessarily going to be paying interest on that. But if you are if you're overly leveraged with regards to liabilities, especially cash, when you're borrowing from another institution, you're going to be at a shortfall every single financial year that you have those loans, because you have to pay interest. So let's check the 2020 financial year to see how it's done net change in cash. So the company's net change cash was 465 million euros in 2020 and 885 million euros in 2019. So it's definitely burning cash very, very fast. So let's just hope that it doesn't continue the negative net change in cash figure into the next financial year, because it won't be a good idea for attracting prospective shareholders. So thank you guys for watching. I'll see you in the next one.